Cullen, welcome back to the Hedgeye Investing Summit, where we wanted to end with Anchorman with Kyle Bass on one of the most important topics, obviously, to anybody who's invested in global macro markets or anybody who cares about the world for that matter, which is what is actually going on in China. So thanks, Kyle. Thanks for making the time. Always enjoy having a conversation with you.
Of course.
Yeah, we just spent some time together in Texas, Kyle and I, had one of our sit-downs, and I just want everyone to just be aware of the process by which I come to my own conclusions. Obviously, a lot of what I think and know is born out of that, but also, and then we can texturize that with where Kyle's coming from. So again, we only care really about measuring and mapping the cycle. I'm going to give you 5 quick slides on that and then dive into it with Kyle, because the real question here is whether the cycle slowing is a secular and long-term problem. So if you look at our current slide deck, our macro slide deck, you'd start with slide 29, which is really the fake news that has been China. It wasn't a fake stimulus, it was actually stimulus, but the question is, can they comp the comps or comp the stimulus, which was, by the way, if you didn't know, now you're going to know, the biggest stimulus in the history of China, fiscally and monetarily. That equated to 50% of Chinese GDP growth, just to round off the numbers, and a massive push to global growth that ended abruptly in Q1 of 2019. So 3 more quick slides on that. You can see what's happened since, and our call was China slowing in Q1 of 2018. So we did get the timing right. But again, you can see on slide 33, obviously their reserves have collapsed. The dollar being up at the 20-year high has obviously been a problem because they're funding a lot of their issues in U.S. dollar-denominated debt. Next slide, you can see what's happened to China, which Kyle's the first person to call out, which is, and I might add, way early, which was right on the screws right, which is China's come from a current account surplus to a developing current account deficit, hence why they have to fund their deficit in dollars. And then on the right side, also Kyle's probably done the most work on, which is where the non-financial sector credit is as a percentage of GDP, which makes Japan and the U.S., for that matter, look like we don't even know what we're doing yet, if that's what you're into. Second to last slide, you could see on slide 35, what is it equated to? A lot of people who thought that if they stimulated, like people who think like Americans think, because if only because CNBC tries to teach you that every day, you buy stocks when the Fed stimulates. I mean, the Chinese have stimulated 6 times, or cut their triple R rate 6 times, obviously since they started to slow, and it's equated to nothing but more and more and more slowing of that chart on the right, which is we're showing you the shadow financing year over year and lending. Last chart, which is slide 59. This is the thing, Kyle, that I wanted to hand off to you. You and I have gone through this quite a bit, which is secondary industries in China are the leading indicator. That's what they stimulate: heavy construction, partly empty cities, all of that. And if you actually, the next slide, slide 60. And what's happened, and that happened on Friday, Kyle. I mean, you know this number, but I just want to make sure everybody else knows the number. I mean, this has slowed to 14% year-over-year growth, secondary industries, to 6.8 to 5 in 1 month. And that even surprised me that the Chinese were willing to report that bad of a number. And it just begs the question, which is, has this line been trying to slow to zero multiple times, really for the 3rd time in 20 years? And do we have a secular problem that's just staring you and readily apparent on the screen on numbers that they actually tell us, which you would acknowledge are made up numbers in and of themselves?
Yeah, no, I mean, you make a bunch of great points there, Keith, and I think it's important to focus on the fact that when in China's ascendancy, call it post-2001, post-WTO ascension, they were growing much faster than anyone else in the world, right? And what they were doing is they were taking growth from their other ASEAN neighbors, right? They were competing for growth with their own workforce and their own burgeoning technology industry. And what you're seeing now is the law of large numbers catching up to China, where they're going to end up going from 8 to 7 to 6 to 5, all the way down to 2 or 3. We think they're growing at, if you look at the actual numbers, we think they're growing at about 2%. 2.5% last year, and maybe somewhere between 0 and 2 this year. And I think it's important to note that China won't be able to grow faster than the rest of the world now that things on the labor side have equalized. And that has a lot to do with their current account. And you showed that other chart of China's dollar shortage, which we focused on. When we think about China, we think about it in 2 different ways. One is domestically, and domestically they control the printing press. They control the price level, the police, the narrative. And how many times, Keith, have you been sitting with someone and they say, but it's China, they can kind of do whatever they want to do?
Yeah.
And I say that's true domestically to a certain extent. But the real issue here is, and this is Hong Kong, but I want to keep going on China for a second. The real issue is in China, you've got the situation where they, on cross-border currency settlement, if you look at BIS data, it only represents 0.9% of all global trade and cross-border trade settlement. And they purport to be 15% of global GDP. So China's problem is they still have to interact with the rest of the world. And as they interact with the rest of the world, they have to buy crude oil. They're short crude. They're short energy. They're short food. They're short basic materials, right? They're short many things that they actually have to buy to keep their GDP growing internally. So if they're showing GDP growth internally, they still have to continue to purchase things with their dollar balances or their FX balances. And so, Keith, the way that they've been plugging that hole for the last couple of years is coercing people like MSCI and the Bloomberg Barclays Global Ag Index to shovel dollars to China because their current account's gone flat and we think secularly going to be negative from now on. So China's real problem is now the rubber's meeting the road. You say is secular meeting cyclical, and the answer would be we would still have cyclical impulses in China if we didn't have this secular problem. And the secular problem is they're running out of dollars.
Yeah.
And as soon as the world figures that out and the U.S. intelligence and presidential cabinet figures out that they're running out of dollars, they realize that in these negotiations, the U.S. holds all the cards.
Well, in that regard, that's the next step. There's multiple different paths we can take off that platform for the discussion, and we will do Hong Kong in full. But on that point, like, do you think that the Fed or the president or both understand the gravity of this dollar illiquidity problem, and that we truly do hold the cards? And that we can control the situation overtly if we would prefer to. And I guess the second part of the question on that is, why would they? Because obviously if they were to step on it the wrong way, they'd step on a lot of things in the stock market the wrong way too.
Yeah, so it's a good point. So our president behind the scenes is very focused. He's intensely focused on the stock market, if you can't tell. His people behind the scenes tell me that he doesn't want to do anything that could potentially jeopardize the stock market. And so the answer to your question is, even if he may understand that he holds all the cards and the U.S. holds all the cards, I'm pretty sure that what Trump's looking for pretty much at all times is, quote, a deal. And that deal may not be synonymous with, say, the long-term betterment of our nation. Yeah. And unfortunately, Mnuchin's probably looking to finance his next movie by the Chinese when he's out of the Treasury Secretary position. And so Mnuchin's kind of co-opted by, one might say, the evil powers. So if you're asking if they're going to go ahead and throw that switch, I don't think they will. But I do think that there are many other agencies within the U.S. That can do things administratively and even legislatively, like you saw in the Hong Kong Democracy and Freedom and Democracy Act, which passed with a verbal vote in the House, i.e., an overwhelming supermajority. And when it gets to the Senate, I think you'll see a potential veto-proof majority there, supermajority there, which will make it much tougher for the president to execute his own agenda without that of Congress's opinion. And so you're going to see things happen from here, Keith, that are outside of the president's control. Yep. And those are things that are going to be really important to pay attention to.
Yeah, the legislative piece, I think that's an important point as a catalyst related to Hong Kong that you can't ignore, and it's certainly new. Derek Scissors, who you know was with us last week, who was from the American Enterprise Institute, the Chinese scholar on that front, who's quite vocal in terms of, he's also his it's an ungodly task. He Kyle every day has to kind of basically measure and map what the next deal is going to be, which has got to be brutal. But Scissors' point was, look, the best you can expect is, and I wanted to get your opinion on this, I hadn't asked you yet, but he said the best you can get is some kind of a deal on eliminating the 12/15 or December 15 tariffs. You're not going to roll back any tariffs. Trump loves tariffs. That's not going to happen. You're not going to get any technology transfer, nothing in writing on that. and you're certainly not going to get any of the things that you talk about, which is any change to human rights violations or anything like that. Do you think that 12/15 date, if it were true, if we were not to implement those tariffs, that would change the secular path of Chinese growth slowing?
I mean, look, I don't. I just think that will help the trajectory not get worse.
Right.
But I don't think pushing back that potential tariff date is going to make anything incrementally better. It's just going to slow down things getting worse, or let's say not accelerate things worsening. But it's important to note that even in the what they call the skinny deal that was just announced, that they're still working on papering, because I know these 3 issues are so hard to paper and must take weeks. But the third issue was Huawei being able to sell what they deem to be call it non-vital or non-intelligence problematic assets in the U.S. And I don't think we're going to get there as a country. I don't think we're going to get Huawei in. And I think what you're going to see out of the Justice Department in the next few months is you're going to see the Justice Department, tariffs are a sledgehammer, right? They're a very blunt force instrument that Trump likes to use. But you're going to see DOJ start using the FCPA, the Foreign Corrupt Practices Act, and they'll use that like a scalpel, and they'll start cutting companies out of the U.S. that are endemically corrupt. And you could, and a lot of the corruption that exists in many of these companies is actually already documented in court cases around the world.
Right.
Call it Central and North Africa, the Middle East, and Asia. All you have to do is go pull court cases, and our U.S. attorneys can just cut some of these companies out. And again, that isn't up to President Trump.
Yeah, well, that, and I know you have a lot of respect for him, Brigadier General Spalding's recent book, Stealth War. And it kind of blows your mind that these things have been happening and they are documented. I mean, if you haven't studied them in sequence or watched the time series like I have a central tendency to do, it's like, oh my God, this has actually already happened and everybody knows it.
Yeah, well, I wouldn't say everybody already knows it. I think, even when you go, I spent a week in D.C. meeting with people that focus on China and issues like this. And when I brought up the fact that Chinese companies that list in the U.S. don't actually have to adhere to the same standards as U.S. companies listed in the U.S.
Yeah.
They don't have to submit themselves to covered audits or become Dodd-Frank compliant to raise money in the U.S. Many of the congressmen and senators looked at me like I had 3 eyeballs on my forehead. They actually didn't know. And so there are many things out there that people just aren't aware of.
Yeah.
And they've been suppressed, or the press hasn't carried it for whatever reason. And, the press is run with this issue of, the president's deciding whether or not to stop capital flows to China. This isn't up to the president. This is up to our legal system, right? And our Securities and Exchange Commission, and maybe even our Department of Labor. And we can get into that. But there are administrative changes that can be made, and then there are legislative changes that can be made that are completely outside of the president's wheelhouse that can actually stop these capital flows. And Keith, I think you're also going to see. I know this sounds crazy, but maybe we should require foreign companies to adhere to the same standards as U.S. companies when they raise money in the U.S.
Wouldn't that be, just a bright light, like that they actually have to comply? This stuff, I mean, and I meant everybody euphemistically, right? So you end up in a place, though, where, I think this is a major problem with Wall Street. Like, they're going to paint Kyle Bass as this guy on China, or they're going to paint me with whatever they want to paint with me today. But generally, what you're doing here, and what I certainly aspire to do, is creating a level of awareness. Let's start with the educational process on what's already happened. So I want to do that on Hong Kong next, because I think you've done some great work on that. You've obviously got some slides ready for that. But just a general level of awareness. It's kind of like let's say that you and I don't nail every single move of every single day of every single thing in every single market. We're still going to provide somebody with an education, so that more and more people are aware. I mean, awareness is where risk management starts. So maybe if you want to kick off on Hong Kong. Yeah,
let me make one comment on that, then we'll go into Hong Kong. I think we all look at the incentive structures of all the players in every game that we look at. And you saw it in the NBA. Their incentive structure was money over morals, right? Or money over freedom of speech. And I think The incentive structure, you mentioned Wall Street, the incentive structure of Wall Street is to embrace China, is to hope that more M&A happens, that more IPOs happen, because they just see fees. They want 8% of this, they want 10% of that, they want 5% of the next deal. And Wall Street would love for that wheel to keep turning. And so they are incentivized to oppose CFIUS reform. They're incentivized to love China, not hate China, because China dangles that golden carrot out in front of any Wall Streeter that wants to chase it. And so the incentive structure has been put in front of the various constituencies, and that's why it's difficult to hear the truth about what you and I are talking about today. And so the good news is it feels to me like that tide started changing about 6 months ago, maybe a little further.
Well, I mean,
and I think it will continue to change. So let's talk about Hong Kong.
Well, because that's what changed it. I mean, I'd say it's certainly one of the big parts of it. When people start, it's staring them in the face, and it's on television. It's not just a Wall Street friend of theirs that's asking the questions. I mean, people are taking water cannons to the head at a bare minimum. Much worse has happened, obviously. But this is, this has gotten people to feel, Americans actually probably feel guilty if they made a lot of money on this and that they didn't really put up their hand. It's explicit. We know this. So again, we have a lot of clients on this call, by the way, that are private equity clients, institutional money managers. Obviously, they're not, I mean, if they want to fire me for hosting this call, then so be it. I'll live another day. But the reality is that we're still going to make them aware of different points of view and certainly make them aware of the data that you have right here in Hong Kong in particular.
Well, I'll issue one warning before we get into Hong Kong. For those clients that are institutional fiduciaries, and more importantly, ERISA managers, if they're a private pension fund manager, all right, they're held to a higher standard of their fiduciary capacity. And if you read, it's a DOL rule, right? The DOL set up the ERISA Act of 1974, and in that act, it stipulates that they need to run their fiduciary role as a, quote, prudent man. And the prudent man rule stipulates that they need to execute higher levels of diligence and consideration for the investments of the pension fund. Well, I have one question for you, Keith. Do you think the definition of prudence should equal investing in a country that has no rule of law, that doesn't submit themselves to covered audits, that isn't Dodd-Frank compliant? I don't know how investing money in global indices and or directly into China A shares or H shares that don't submit to audits, I don't see how you could be deemed to be prudent. And therefore, your legal liability is a lot larger than you think it is. And I think you're going to start to see plaintiffs' firms come after you. And so I'll warn you that that's coming.
Well, it's a good thing I'm not running money.
Let's get into Hong Kong.
Okay, let's do it. All right, so you guys have Kyle's slides, the Hong Kong economic shift to goods and services. Maybe we start with that.
Sure. So the point I try to make here is a simple one, and basically Hong Kong, as we all know, used to be the largest port in the world by 20-foot equivalent unit throughputs or container throughputs, and they used to be a massive net goods exporter and re-exporter for southern China and themselves. And what you see here is in the red bars are goods. The blue bars are services. And what happened, I think, to the untrained eye, you'd look at this and say, well, it looks like the global financial crisis turned Hong Kong's economy upside down. And I think it's just coincidental that, as you know, China ascended the WTO in 2001. And in that ascension, what happened was they spent an enormous amount of CapEx on their southern port infrastructure. So Hong Kong used to be 23% of the 10 largest ports in the world throughput. 15 years later, they're 6%. China used to be 9%, and now they're 61%. So what happened is, while Hong Kong used to be the southern port for China, now Hong Kong's just another city in China. And so they flipped, and now they're a services-based exporter and a massive net goods importer. And when you think about these things, they face China on all their services, and they import goods from the rest of the world because Hong Kong is now net short goods. And why is that relevant? So when you go to the next slide, Hong Kong's relative importance from a financial perspective, Hong Kong used to be a quarter of China's GDP in the early 90s, and now it's back down to about 2.5%. Strategically, it's really important from the perspective of geopolitics. Financially, it's important from another angle, and of course, we all know that's because this is where China raises all of its dollars. The majority of its dollars is through Hong Kong. But their GDP as a percentage of China's GDP has waned. So the next slide shows you that what's gone on in Hong Kong. When you look at private sector credit to GDP, Hong Kong's the most levered nation in the world. And Keith, when we talk about the macro and taking 5 or 10 steps back to understand what just happened, you think about this. Hong Kong's been pegged to the US dollar and therefore has imported US monetary policy for 36 years. And that import requires them to basically let Jesus take the wheel and more importantly, meaning Greenspan and Bernanke and Powell, they take the wheel and they dictate Hong Kong's monetary policy to a significant extent. And so what happened going in the financial crisis is we dropped our rates from 5% to 0. Hong Kong came along with us. At the same time, Hong Kong's largest trading partner, China, hit the gas pedal. And so what we've seen so far is we've seen Hong Kong's real estate market explode. Imagine money became free right while their largest trading partner started growing double digits. So from 2008 to 2018, it was the best 10-year period Hong Kong will ever see in its entire existence. It'll never happen again. And so what's happening now, going back to slide 5, is what happens when money goes free. Well, you notice on this chart, there was a slope that was fairly linear, and then it kind of went parabolic. Well, it went parabolic in 2008 when money became free. Mm-hmm. But private sector credit to GDP of 300%. And you guys know how levered the US and Japan are in the private sector. They're both around 150. So Hong Kong's leverage, Hong Kong is the most levered developed nation in the world. You look at page 6, Hong Kong's banking sector is now 850% of GDP in assets. And Keith, you remember back when Europe had their issues back in 2011 from their own financial crisis. You had Iceland, Ireland, Cyprus. They all fell like dominoes because their banking sectors got to be 8, 9, 10 times GDP. So if you lose 3 to 5% of your assets, it literally bankrupts your entire sovereign.
Right.
And so what's happening in Hong Kong now is you've got enormous amounts of leverage and you've got enormous amounts of banking assets. And now you've got a problem on page 7 with interest rates versus liquidity. This is a busy chart. It's a scatter diagram of what we deem to be their excess reserves. They call it their aggregate balance. So the way the peg works is for every 7.85 Hong Kong dollars that are in the system, there's $1 in their system. And they claim, and the people that are the architects of this peg claim, that it's an impenetrable peg, i.e., the peg's perfect. And I'm going to point to a few things that'll tell you why that isn't true. But the point we're trying to make here is outside of the actual dollars they had in their system, they also have their rainy day fund, which is what we call their aggregate balance. And that's this chart that we're looking at here. And what we're seeing over time is now the aggregate balance has declined from, call it 270 billion HKD to 55 billion HKD. And we're in the convex portion of the rates curve. So once they run out of excess reserves, they're actually going to have a liquidity issue, and they're going to have to raise rates to maintain their currency. The problem is in Hong Kong, as those of you that live there or that bank there and know this, is 95% of the loans in Hong Kong are indexed to 1-month HIBOR, and they reset monthly. And so you can't raise rates like they raised rates in 97, 98 to keep the peg, because you'll detonate an over-levered banking system. So I'll make a couple more points, and then Keith will get to some questions if you want to ask some questions. But page 8 is a really important page. So last month, what we saw is a $16 billion decline in the reserve balance of Hong Kong. And what that means is money just left the system. And people say, but that's okay, because when you extinguish an asset, you extinguish a liability, the system's fine, it's not going to break. And this gets into the May 20th letter that we wrote, Keith, that we're happy to share with you if you haven't seen it. But in there, we talk about the Fed, and we say the Fed, the U.S. Fed got to 4.7 trillion on its balance sheet, and their goal, their stated public goal, was to get that Fed balance sheet down to 2.5 trillion. We wrote May 20th that it's our view you can't get it below 3.5 trillion just due to Basel III requirements and the amount of liquidity and repo leverage in the system. And what we saw recently is we saw Fed funds spike, and we saw liquidity problems in the U.S. that the Fed had to immediately respond with. And people at the Fed, especially Williams, who said that this was a pipe dream and it was crazy, all of a sudden realized that he was dead wrong. And he was dead wrong about the amount of liquidity in the system, the amount of usable reserves, the amount of collateral in the system. The same is going to hold true for Hong Kong. If money leaves and they have to extinguish assets and liabilities and let's say contract M2, you can't contract M2 when your banking system is 900% of GDP and private sector credit's 300% of GDP. So that's a really important point to make for those people that think all's going to be well. If currency pegs worked, if currency boards worked, it's actually technically what they have is a currency board, then Argentina would still have the peso 1-to-1 to the dollar. Right? Argentina's peso was 1-to-1 to the dollar, and they had, quote, a perfect currency board, just like Hong Kong, going into 2001. And now where's the Argentinian peso, Keith?
Yeah.
I think it's 58 or something like that, right? They've lost all their power over time. Now, again, the political situations are different. However, let's go to slide 9. So typically this time of year is when Hong Kong has an enormous tourism influx. Well, as you see here, tourist arrivals from China are down 40% in September. All arrivals are down over 21%, and the all arrivals number is lagging. And so we're hearing that the October numbers are worsening. And so you've got a problem when you go from a high growth, highly levered country into a country of contraction in the money supply, contraction in revenues, contraction in trust in the government. And these things don't hold together when the leverage is as large as it is. So if you're invested in Hong Kong, I suggest you pay a lot of attention to this and decide whether or not you want to be around when things really hit the fan.
Mm-hmm. I think the answer to that is, generally speaking, not many if they're aware of the situation. The president of our firm, Michael Bloom, who helped me with the discussion with Spalding, he was just in Hong Kong, and it wasn't to go on a tour. It was to close his bank accounts. And I think that's maybe you get a little bump on the tourist numbers just for that. People, but quite seriously, I mean, people that understand the situation have taken this seriously. And I guess ultimately the question is, if you have what is a broadening recession, this is not a debate on economic terms. These numbers are, their rate of change numbers are going to be published weekly, monthly. Whenever I get the numbers, I'll reiterate it on Hedgeye TV and the Macro Show every morning. That's not a debate anymore. The question is, how deep and interconnected of a recession/depression do they have in Hong Kong? And that's really, I guess, the question I have for you on that, because it's one thing to not have a run on the bank in Beijing, but it's entirely a different one in Hong Kong, is it not?
Yeah, I mean, when you think about the construct of the banking system in Hong Kong, the two of the largest banks in Hong Kong are bankruptcy remote subsidiaries of British depository institutions in Standard Chartered and HSBC.
Right.
Right. And I can tell you this: if you understand the way the UK law works, it's not going to be UK taxpayers bailing out bankruptcy remote subsidiaries in Hong Kong when the shit hits the fan. Then you've got Bank of China Hong Kong, which does all of the RMB settlement. And Keith, one thing we've noticed in deposit rates, the Chinese banks in Hong Kong and the Hong Kong banks have been offering 2 to 4 month deposit rates of 6 and 7% when 1 year HIBOR is at 1%.
Yeah.
Right. So they're really struggling for deposits, and they're having to raise rates massively for what they call new money, just to try to attract new money in. And you remember going into the subprime crisis, what happened to the banks here? The worst offenders that were charging giving out or awarding the highest depository rates were the worst offenders. And that just when you saw Fremont Savings and Loan and WAMU and the others paying higher and higher deposit rates to try to attract capital, that was the precursor for the failure.
Yep, I mean it always is, and I guess the one thing that has insulated China itself, China properly, as opposed to just like you said, Hong Kong, is that they have that closed capital account. So they have not had your emerging markets current account deficit driven currency down in a ball of flames setup. But you essentially you're saying that okay, maybe. Well, actually, I don't know. I think you wouldn't say that that's never going to happen in Chinese yuan terms. But here in Hong Kong, you're saying the probability is that it happens sooner.
Yeah, the only reason it hasn't happened in China, if you look at the numbers, is they've been able to come through Reg S exemptions. They've been able to come to U.S. markets. Chinese corporates have borrowed $1 trillion USD. If you look at the BIS numbers, it's like 1.1 trillion, and they borrowed it all in the last 4 years. And now they've got MSCI and the Bloomberg Barclays Global Ag Index funneling them, 80 billion here, 100 billion there. Again, U.S. forced investment through passive flows is it's the only thing keeping their capital account at the break-even level. Yep. So to your point, if those flows titrate, slow down, or are stopped altogether, China's going to have a real problem with their dollar shortage.
Massive problem. This is, and I think it's a big thing that people get wrong on Wall Street. Again, there's DC people, there's Wall Street, and then there's everything else. I mean, there's a lot of divide in terms of people's awareness on all these numbers, time series, where we came from, where we could be going. By the way, if you have questions, thanks for submitting them in the queue, Kyle. I'll start to fire some off. Actually right away, because some of them are obviously going to be better than mine. And one question, it's a follow-on to what I was going to ask anyway. How will China respond, if at all, to a break in the Hong Kong dollar peg, and how do you see this playing out, Kyle?
I mean, my view is that if China has the best economic and financial system like they say they have, which of course we don't believe them, right? All the integrities in the U.S. system. And we've been at this a lot longer than they have. But if they do have it, then why is Xi's little colony still pegged to the dollar anyway? If you look at currency pegs throughout history, the currency that is pegged to, call it the parent or the host, their economies have to have a fair amount of synchronicity, i.e. when they grow together. When they contract together. And that allows the peg to work. So I think the peg will go from a dollar-based peg to an RMB or an Asian basket of currencies, and I think it will happen in one day, right? China will use its RMB exchange rate to buy the dollar reserves of Hong Kong, and in the time it takes that trade to settle, which is one day, they'll be pegged to the RMB, and I think that'll happen at some point in time.
It's certainly been a differentiated view. And look, and this is the way risk works. It happens slowly, then it happens all at once. All the different things that cause it are measurable. You can map them, like I said, weekly, monthly, as you get more incoming data, more market information. It's fascinating to watch how Asia trades, as you know, every day relative to the U.S. FOMO. I mean, people are just hoping and praying, literally praying, that Trump tweets something that gets a deal done. But the reality is it's been the cycle all along that's caused market disconnects. And again, look, since we've got the bean deal, or whatever the heck that thing was a couple weeks ago, in Shenzhen stocks are down 2.5%, and in Shanghai they're down almost 2% over that same time period. People are just, batshit crazy chasing the 50-day moving average in the S&P 500.
Yeah, I mean, look, any crackerjack president can get the Chinese to buy some food. They're short food.
Yeah, lots.
Right, and so that's not that big of a deal. But I think when you get into the substance of any of those issues, I don't think there's a deal to be had. The real issue, truthfully, Keith, is President Trump and which side of the bed he gets up on that day, and whether he wants to, quote, have a deal. I was sitting in a meeting with one of his advisors who said, you realize if Trump just does a deal and just gives in, the Dow will go up 5,000 points, and Trump will get reelected. And he smiled like, that's a great idea. And, I looked over at him and I said, at the expense of hollowing out our country. I think that's crazy. But I'm just telling you, on the advisor side, that's what's being typed in.
Yeah, I mean, and it's the same thing actually Scissors said. He said, look, the reality is what it is. Trump will decide on that day what he's going to do and why. But he also reminded me that Trump loves tariffs. Trump loves America. Trump doesn't love Xi. I mean, there are a lot of different issues, and he certainly doesn't love death camps or these. Actually, that's one question I have before I take questions about what you've already said. What is it about that, and does this find its way back into the new U.S. legislation on Hong Kong? The human rights side of the equation, the Uyghurs, and the numbers that you've outlined. I think you've really stirred the pot in saying this 3 million number on death camps. I mean, A, is that true, and B, is that something that your average American might just say, wow, that is completely screwed up?
Yeah, I mean, I urge everyone that's listening to look at ChinaTribunal.com. It's the UK just held a tribunal. The person that oversaw it was the same QC, Queen's Counsel in the UK, that oversaw Slobodan Milosevic's war crimes tribunal in The Hague. So this is a bona fide, hundreds of interviewees tribunal where the UK determined that they are live organ harvesting. They're organ harvesting out of live people in China from prisoners of conscience, i.e. Religiously or ethnically persecuted people. And, I was sitting with someone on the Senate Intelligence Committee who said something to me that was just kind of off the cuff, and I'm not going to tell you who it was, but they said, we knew this was going to be bad when we saw the crematoriums being built at the concentration camps.
Ugh.
And he said, the smoke, they're not choosing a new pope every day there with the white smoke. This is horrible what's happening there. And I think we all turn a blind eye to that, either A, hoping it's not true, or B, we don't want to think about the ramifications of a disengagement with China. But for some reason, we keep engaging them. And I think it's profits over morals. But I think we're going to start to enforce Magnitsky sanctions against the worst perpetrators there. Look, Keith, I'll give you a couple of anecdotes. The province of Xinjiang actually came to the U.S. markets and borrowed $200 million from U.S. markets so that they could build out the concentration camps. Then they went to the World Bank, and on the World Bank's balance sheet today is a $100 million loan to the government of Xinjiang. They needed some more money for construction materials.
That's disgusting, man. That is
unbelievable.
Ugh. I mean,
people say to me, well, what would happen if we disengage with China? U.S. GDP would drop 1.5% to 2% immediately. And I said, I just don't care. They steal almost 2% of GDP from us today, every year. And they actually earn a positive return on their theft. Mm-hmm. So I think it'll be a wash over time if we just disengage. Will our T-shirts and sneakers cost more? Yeah, but somewhere in Vietnam or Cambodia or Malaysia, they'll make it. It'll just cost a little bit more.
Yeah, and you said that it's people over profits over people. Actually, I think it's profits over awareness. Like like you said, in the last 6 months, something has clearly changed. I see it in every institutional meeting that I have. I was in Chicago yesterday. I was with you in Texas a couple weeks before that. It is now part of the debate. In fact, it is central to the debate, and it's people
Right.
haven't had to worry about that. So it's like anything else. If you turn a blind eye to what is obvious, you can only do that for so long before everybody else sees it as being obvious. So I think that I would bet, it'd be betting against the spirit of America to bet that we just sign off on that at the expense of profits. I would not bet, I would not have that trade on if you paid me.
I agree. And I think that, look, I chaired the risk committee of UT's endowment for the last 3 or 4 years. And had been on that board 9 years and just termed off in September. But the University of Texas Investment Management Company had its first open board meeting debate about the pros and cons of China last month.
Wow.
First one.
So it's on.
And so it's just starting to happen. It should have happened long ago, but it's just starting to happen. And I think when you see suits brought against ERISA managers for breaching their fiduciary duty to their investors, when you see the DOJ start to use the FCPA to carve Chinese companies out of the U.S., I think that awareness level will go up exponentially.
It is in motion. Like I said, at first it happens slowly, then all at once. On this question, there are a bunch on fiduciaries, and keep them coming. Thank you for the questions. Speaking of fiduciaries, Kyle, please comment on what would happen when it comes to the time to make withdrawals of corporate profits or pension money from China, and these fiduciaries find out that they can't.
Yeah, that is a great question. I'm of the opinion that given that tenuous balance of dollars in, dollars out of China, there are still, you probably know this, when China first started opening up to institutional community, you could invest directly in an asset manager like in a commingled fund, but you could also set up a QFII account, which was basically an approved institutional account by China.
Mm-hmm.
I think that today there's still limits on how much you can withdraw from your QFII account. So the fact that China claims to have a true market-based economy, A, is a joke, but B, I'm afraid we can't get our money out. And so when people realize they can't get their money out, I think that's going to cause problems with U.S. auditors here. And right now, you might be keeping those assets as a level 1 or level 2 asset in China, and you might be forced to mark it as a level 3 asset. You might have to start to discount it, which will, of course, dramatically change your return profile as a fiduciary.
Yeah, this fiduciary problem, I mean, man, this is that's certainly recasting it within the lens of something that gets people's attention. And there are a lot of questions on that people are.
Let me give you one more anecdote on that. There's a top 10 E&P multinational that has a little bit more than $1.5 billion in cash in China, and they've been trying to get it out of China for 2 years, and they keep getting inundated, pardon the pun, with red tape, and they haven't even disclosed it to their shareholders, which is something interesting to me. It's a public company, and for 2 years they can't get out $1.5 billion, and so it's interesting to me that their auditor still considers that to be cash.
Yeah, that's what we would call a level 3 asset, I think, legally here in the U.S. And we know what those are now post-Lehman. But nobody knew what those are either, Kyle, until after Lehman.
But Keith, what's interesting is they're not incentivized to tell anyone about it, because then what if China shuts them out of doing business in China because they told everyone China won't let them have their money out? Right.
Now, on that, like, anytime there's a situation like this, you have what we call quad 4, or actually in China's case, it's now quad 3, because inflation, even on their own reported numbers, just hit, as you know, a 6-year high last week. So what they have is actually economic stagflation, which can be much more problematic for levered assets, however you may classify those assets. So when I think of that, it's like, well, straight up the middle, what you do is you short the largest base of credit that is the least liquid, which would have a bullseye on private equity. Private equity, obviously, not to name names like Schwartzman, but there are certainly plenty of players who have done quite well by being partnered with the Chinese. How do you think that plays politically? Is it an election issue? Is it just an issue for now? Schwartzman's company is obviously public.
Yeah, again, not to name names, I think that Chinese private equity is going to be a very big problem. I don't think the private equity firms that have huge investments in China are going to be able to harvest them. Private equity in general has been a great space for all institutional fiduciaries over the last 10 years.
The best.
And I think it'll continue to do well in the U.S. I think if you've got Chinese JV partners or you've got Chinese private equity, I think you should just buckle up, because it's not going to go well from here.
Right. But you do, I know that you know, so I just want to put that on the table. I mean, you do sit at the table where there are major players from Wall Street, whether they be from the asset management community on the private equity side or otherwise, where there is a genuine lack of engagement on the topic. Because to engage would be to admit, and that's not where we're at. That is not a good place to have a discussion right now.
I actually want to make a point, though. I know I've met a lot of these private equity principals, and believe it or not, there are private equity firms that are huge private equity firms here in the U.S. that made a conscious, thoughtful decision to never engage with China. And now, while they might have taken some Chinese investors' money as LPs, there are private equity portfolios in the U.S. that are very large ones that don't have one Chinese investment. Right. And so I think there are some thoughtful people out there that were willing, again, to forego the juggernaut or this allure of great returns in the future because they thought it was too problematic. There are others, as you know, that went all in and have 60% of their entire firm invested in China, and those are the ones I think are going to be in trouble.
Yeah, there are a lot of a lot of different ways that can go. Obviously, I guess on the technology topic, there are a lot of questions, Kyle. I mean, just to boil it down, do you think there's a hope in hell that the Chinese admit that they even stole our technology? Never mind, we have a deal on it.
No, it's antithetical to their mission. Keith, I'll make one interesting point about this. You know, whether you read the DIUX report, which is DoD's report on how much technology is stolen annually, or whether you read the trade reps report to the White House, the numbers bandied about in both reports, which are multi-year investigations, are somewhere between 200 to 500 billion a year in technology theft and forced transfer. Think about a number that big, and Keith, have you ever read an 8K that says China stole X billion of technology from us, and we need to let you know that they stole it? It's interesting that no companies in the U.S. have ever admitted theft, but our government's telling you that 200 to 500 billion a year is getting stolen.
Yes, you would never write off the idea of getting that next incremental order, would you, Kyle? I mean, there's
well, no, the only place I've seen it is right in lawsuits where we saw Huawei stealing the Tappy the robot case. I don't know if you've read that one.
No, I haven't.
Oh, you should read that one. That's a good one. They have video of the Chinese engineers putting parts in their backpacks as they walk out of the lab. Anyway, you got to read the lawsuit and watch the videos. But that's one. And then in the Duke technology case, where the Duke PhD student ended up taking the metals, the materials science ideology from Duke in order to build China's hypersonic weapons. It was just truly remarkable.
Yeah.
And so think about this: the NIH funds huge portions of our entire university budgets in the United States. I think the U.S. government should say, you know, if you're not going to put real controls on your technology and the ability and limit the ability of foreign actors to steal it from you, we're just going to stop funding you.
Wow. And
but we need to bring accountability to the university system.
So many of these subtopics that are interesting. We only have about 5 minutes left here, Kyle, but there's another topic here and a lot of questions on this too, because you just brought it to bear. So people are like, so what's the catalyst to get U.S. politicians to act? You know, on many different levels, that's the question. I want to tie that to what I learned. I didn't know. I mean, I'm Canadian, for God's sake, so I don't know that Mitch McConnell's married or who his wife was within the context of who Spalding taught me his wife was. You know, how is, I don't know, maybe that's an open volley for you, but you know, you have a significant U.S. political leader who has been able to do what he's been able to do for so long. At the same time, from what I understand, he would be pro legislation on Hong Kong.
Yeah, so this is you're throwing me a lit firebomb. But
it's a Canadian lit firebomb. We just had an election. I'm good. I'm fine. Everything's cool. We're all nice again. Right. We get along with everybody. So take it.
No more blackface pictures of Trudeau. We're finally through the gauntlet, right?
Yeah.
But I think I direct everyone. If you look at my Twitter feed from yesterday, as you know, the Emperor of Japan was in a formal ceremony yesterday, and there is a video of McConnell's wife Elaine Chao talking with Wang Qishan, and actually they're talking like they're not supposed to be talking to each other, and Wang didn't hear. And look, she's got it there. Oh, you've got it pulled up there. Notice they're pretending not to talk to each other. But I find that to be fascinating and interesting altogether. Elaine Chao, as you know, was in Bush's cabinet, is in Trump's cabinet, and is definitely in McConnell's cabinets. But I think back when they were dating is when here's a fun fact: the Hong Kong Policy Act of 1992 was sponsored by none other than Mitch McConnell, and it was when he was dating Elaine Chao. They married the next year, and so I'm not saying she's bad or good. I'm just saying she's incredibly connected over there, and I think it's important to note that if we're going to call the Hong Kong police out for their gross human rights violations and the Hong Kong government out for their lack of autonomy, I mean, if you just look up the definition of autonomy, I'm fairly certain that Hong Kong's lost all autonomy. The problem is there are 200,000 Brits in Hong Kong. There are 85,000 Americans in Hong Kong. The American Chamber of Commerce there is the biggest pro-CCP lobbyist, maybe in Washington, D.C., because all of the people that have money invested in Hong Kong don't want to lose it.
Exactly.
And so they want to overlook all of these violations, and they want to move on. But it's great that you see. I mean, when was the last time you saw Rubio and Pelosi get together and launch legislation that passes with a supermajority?
Yeah.
So you're asking when legislators are going to do something. I'm seeing things happen in Congress and in the Senate that haven't happened since 9/11. I saw unanimity post 9/11, and now I'm seeing unanimity here, which is a very good thing because, again, these are difficult things to look away from once they're put in front of you.
Right, and it's a political opportunity. So what do you think Elizabeth Warren's going to do with that relative to Trump's stance on China?
I think Elizabeth Warren's been looking to outflank Trump on China, and she's done a hell of a job of it so far. But, the real problem is, though, Keith, when I was in D.C., I was meeting with some people to talk about Rubio's Equitable Act, to try to put some things, talk about putting some things in the bill that were more restrictive on foreign listings in the U.S. And one legislator's office that I came into, I sat down and he smiled at me. He says, "Hey, who was sitting right where you're sitting yesterday?" And I said, "Who?" And he said, the former head of the CSRC, the professor at Stanford that used to run the Chinese Securities and Exchange Commission, was here telling me why it's a bad idea to require audits on Chinese companies." And so he was actively lobbying the U.S. Congress as a former head of the Chinese SEC to tell us why we shouldn't require their businesses to be audited because it's a national security problem. And our congressman said, well, we audit Raytheon and Boeing and all the others, and they have all top secret clearances, but the audits don't give away any top secret clearance. They just make sure the numbers are the numbers. And he didn't have any response for that.
That's ridiculous. And I think you dropped a Magnitsky bomb there, too, while you were answering, or just dropping a lot of your knowledge, as you usually do. Isn't that, if I recall, isn't that the Russian legislation on disclosures, corporate disclosures?
So the Magnitsky Act is, I think, the number one tool that I think will be used against gross human rights violations in the world. What it does is enables us to unilaterally sanction and prohibit travel and sanction the assets of gross human rights violators around the world. Bill Browder, former head of Hermitage Capital, his lawyer was Sergei Magnitsky. If you haven't read the book Red Notice,
amazing
I suggest you read it tomorrow. But Bill Browder is a human rights champion, and he is the one that has gone around the various legislatures around the world and brought Magnitsky sanctions to be, and now we just need to implement those sanctions on the violators.
Mm-hmm. No, that's a very interesting catalyst. It looks to me that would seem politically bipartisan at the very core and likely. Yep. So that's important.
Because it's evidence-based. The difference between tariffs and the FCPA and Magnitsky sanctions is FCPA and Magnitsky are all evidence-based. And if you have the evidence, you can go ahead and implement these punishments, and it's very difficult to talk around. If you're just going to slam them in the head with a sledgehammer, it's an effective blunt force instrument, but I don't think it can be used extensively over time. I think you're going to have to get more specific with your grievances.
Mm-hmm. Yeah. So, and maybe a last question on this because we've just run out of time. But most people, when they look at risk, they want it to just be packaged almost maybe in a Tiffany blue box. So it's all right there. That's all you have to worry about, Kyle. It's all just going to happen on that one time with that one catalyst, with that one domino. Clearly, that's not the way that any risks ever worked. But when you think about the dominoes associated with at least your bear case, how does that find its way home? Like, how does it find its way? And I'm talking about markets maybe primarily is where I'm thinking. How does that find its way back into U.S. economic risk, liquidity risks, et cetera?
Well, look, if I'm right about Hong Kong, which clearly we're right, it's just what degree of right we're going to be. And if we're right about China, what does that mean? Well, that means their currencies will both depreciate vis-a-vis the dollar to be the counterbalancing mechanism, and they'll have a restructuring. It's not the end of the world. That happened that happened from '88 to 2002 in China, where they dropped the triple R to 5%, recapped their banks. They'll do it again. Again, the world will move on. But what does that mean in the near term? It means the U.S. is going to have to slow down. If Asia slows down, materially, then the U.S. will slow down and Europe will slow down. We'll have a mini recession. But with that comes a more difficult question, Keith. And it's, once we get rates to zero, will we go to NERP, or will we start buying stocks like Japan? The central banks only know one thing, right? I mean, they have a hammer and everything looks like a nail, and their hammers lower rates and buy things. And so I'm thinking about, I don't think we're going to see a collapse in stock markets like we saw in '08. It's not going to be anything like that. I think it's going to be much more idiosyncratic. I think Asia's going to have a lot more trouble than the U.S., and I think that capital is actually going to flow towards the U.S. And I think we have the most robust, the markets with the most integrity in the world. And I think I'm not sure our stocks will go down that much. I think our rates will go to zero pretty quickly. And then the question is, what happens? You mentioned we had stagflation showing in China. At some point in time, we're going to see some sort of stagflationary impulse here. But I think we're going to see a little deflation first, because the world's going to slow down.
Mm-hmm. Well, that's a good roundup on a lot of different topics, and I think we could have talked for the entire other hour if we had it. But thanks for making the time. You've done so much work on this, and again, like I said, it's not about like when is this call right or whose call is what call for that matter. I just think it's a general level of awareness, and you should be thanked for doing such great work on that, and certainly for making yourself available to our audience. So thanks, Kyle.
You too, Keith. I appreciate the time.
All right, we'll talk to you again. Thanks.
Right.
He's Kyle Bass. You could definitely follow him on Twitter, and he's certainly not shy when it comes to revealing what he learns next. And I highly suggest, in terms of awareness, that you have that on your dashboard. And you can find me there too. Thanks for joining us. I appreciate it.